In this presentation, we will take a look at multiple choice questions related to financial statement analysis, going through those questions and then practicing test-taking skills with them. First question, generating positive market expectations is either A, liquidity and efficiency, B, liquidity and solvency, C, profitability, D, market prospects, or E, avoiding bankruptcy. Let's go through this again using the process of elimination. Generating positive market expectations is either liquidity and efficiency, liquidity and solvency, profitability, market prospects, or avoiding bankruptcy. Of those five, the first four are somewhat similar to our groupings of financial statement ratios. The second one's a little bit strange here because it includes liquidity and solvency, typically the other category being solvency. So I think we can remove B then. We should be able to remove E because it's not one of our four categories. And then we can go through A, C, and D. Let's consider it again. Generating positive market expectations is either liquidity and efficiency, profitability, market prospects. And the fact that it has market expectations in there, we would consider possibly then it would be the market prospects. Meaning if we're thinking about market expectations, we're probably taking into consideration what the market data is, usually, in other words, the cost of the stock, which is going to be a primary component because that's what the market thinks. The market, the way we know what the market thinks is to take the current market price as the stock being traded on the market and use that for our consideration, as opposed to the other types of ratio categories where we only take into consideration the data internally within the company. So final answer D then, generating positive market expectation is D, market prospects. Next question. Industry standards for financial statement analysis either A, are based on the biggest competitor's financial performance, B, are established and maintained by government, C, can be used to compare a company's performance to industry performance, D, are not accurate, E, compare 1 year to a prior year. Let's go through this again using the process of elimination. Industry standards for financial statement analysis either A, are based on the biggest competitor's financial performance. So we're looking at industry standards. Is the industry standard based on the biggest competitor's performance? That might be in consideration. I'll keep that for now. B says are established and maintained by government. Now, industry standards, are they established and maintained by government? Not typically, because we're talking about the financial statements here. The government might force the reporting in some way and or could require things like the tax returns and whatnot, but the industry standards are not typically maintained by the government. So it's not going to be B. C says can be used to compare a company's performance to industry performance. So that might be why we would want the industry standards for financial statements. That seems reasonable. D says are not accurate. That seems like, that's possible, but it seems not likely. And E says, it's not an answer that's likely to be an answer that we would think because we want relevant data here. E would say compare 1 year to the prior year. Industry standards for financial statement analysis compare 1 year to a prior year. I'll keep it for now. Let's go through it one more time. Industry standards for financial statement analysis either A, are based on biggest competitor's financial performance, or C, can be used to compare a company's performance to industry performance, or E, compare 1 year to a prior year. Now, of those three, it seems that C seems most reasonable here. A, are based on the biggest competitors. Not necessarily, because that's not the representation of the whole industry. That's the representation of one company that happens to be the biggest company. So I don't think that one company would represent the industry standard per se. And then E says compare 1 year to a prior year. That doesn't really take into consideration industry at all. It's just one kind of convention we might use. So final answer C, industry standards for financial statement analysis C, can be used to compare a company's performance to industry performance.